Hi, everyone. Roger Connect, President of Universal Accounting Center. I'm excited because we've actually got a wonderful presentation planned this morning with essentially an expert, Ron Mueller, in tax law and how it really affects, most importantly, small businesses and really the role you have as an accountant, tax preparer for these clients. Now, one of the things that I want to just emphasize here is as we're in the pre-tax season, a lot of the times what we want to stress is the idea of planning, tax planning, and really trying to be proactive in the things that we're doing to help our clients maximize the deductions that are available to them legally. Now, one of the things that I want you to understand is one of the most important questions you're most likely to ask yourself is, as a bookkeeper, as an accountant, as a tax preparer, do you know enough about the 53 changes that recently happened and the deductions that became law with the signing of the 2018 Tax Cuts and Jobs Act? Now, this is quite critical because this act was basically 500 plus pages in length and was signed into law in 2017, but it affects this tax year and the tax season that's coming. And with that in mind, there are more than 4 dozens of changes that took effect with this change. Now, 12 months later, what we've got is a situation where as accounting professionals, tax professionals, there are a number of people still waiting to see how Washington and the IRS provide guidance and clarification for these very important tax deductions and these 53 changes that went into effect. So these 53 deductions include things that you need to be aware of that either were modified, watered down, enhanced, and perhaps even eliminated, and you need to know which those are because your clients are going to have some expectations just because of history to presume that certain things are still in place, and that's not necessarily the case. So with a few large, very popular tax deductions now simply gone, you need to be aware as the accountant or tax preparer on how to take advantage of these. And there are some huge, and I do mean huge, brand new tax deductions that have been added to the tax code that really affect things in a positive way. And the vast majority of us, especially small business owners throughout America, need to know what these are. Now, I acknowledge that these are some broad statements, but effectively they are intended to help you to best serve your clients. And so just realize that as an accounting professional, this is your chance to really get on top of what it is. And that's why I've asked Dr. Ron Mueller to record this brief training as to what the impact of the 2018 Tax Act on America's small businesses and home-based business owners should be aware of and how you can be involved in helping them maximize the benefit of this. Now, Dr. Mueller is probably best known as the author of 2 bestsellers, Windfall Tax Savings Approved for Small Business Owners, as well as another book, Executive Summary of the 2018 Tax Cuts and Jobs Act. These are very important ones that we're going to be mentioning, and Dr. Mueller's books are only the plain English that you need to know as an accounting professional to really get the most out of these changes for your clients. And really, it's meant to be something like a review that's really based on accuracy of the IRS codes and policies. Now, the book is in its 18th edition. It's completely up to date with all these new tax laws. And Ron is not only a successful author, but he's also a speaker. So what you're about to hear and listen and participate in is going to be, I think, very, very powerful. So with that, I do want to basically say that today we're privileged to have Ron here with us to go over this 2018 Tax Act and really help us understand how America's small and home-based business owners can really be prepared and plan and benefit from those things that have changed. So Ron, with that introduction, I just want to basically say I'm looking forward to this discussion and interpretation and your reporting of these 53 tax changes to the Tax Act and literally basically see what it is that's changing on a daily basis as we move into the tax season. So Dr. Ron, friend, how would you like to start?
Let's start at the beginning. The Tax Cuts Act, you said this was the first attempt in 32 years to begin a long-needed overhaul of the tax code. We've needed an overhaul for a long time, but since 1986, we have not done anything. Nothing. There was a major overhaul in '86. 32 years later, we started it. Now, this is not the be-all and end-all, but it's a good beginning. Now, before we get started, for some of you are going to be watching this on recording, so I want to mention to you that this will be a content-dense briefing using 100 slides or more. So, if you want to download the slides first, and if you're on this live, you can go to this website right now, getthetextslides.com, and print out a copy of the slides, and it'll make your note taking easier. If you're watching on a recording, then just press the pause button and then go to getthetaxslides.com and download the slides. And then I think as we go through this this massive presentation, you're going to get more value out of it because you won't be writing as much. You can be taking notes instead on the slide, same slide you're going to be seeing.
And Ron, I really appreciate you doing that because I know for myself, I'm a visual person. And so anytime I could actually have those to help me through the process, it allows me to take better notes. So definitely this is a great thing. So with that in mind, let's get into these 100 slides.
Okay. This tax, as I said, this federal law is not perfect, but it's a good start. So just keep that in mind. I think that, I think with this tax bill, there are roses and thorns, but I think the roses outnumber the thorns. So I think in the long haul, especially for small businesses, I think this is a positive move for us.
Well, it's definitely a good one for us as tax preparers and accountants, simply because it's forcing the business owner to have to work with us again to get on top of these changes and properly plan for the new years.
That's right. It's going to keep us and them busy. We mean the professionals and them meaning our clients. As you said, it made 53 changes, this Tax Act did. And every American taxpayer needs to know what they are because there's no one that won't be affected. It's going to affect absolutely every single taxpayer, whether they file just a 1040, a 1040 EZ, or complicated tax forms. It's going to apply to them. There are changes that will affect them.
And one of the things that I think is helpful is the fact that where we're all being paid to do these tax returns, one of the things that I think you're going to see is a lot of people who really did this on their own before, with the changes being as numerous as they are, I think they're going to want to now have someone do their tax returns. So I'm expecting everyone to see an increase in the number of clients that they have.
Well, I've got a lot of people on my email list and that I've developed over the years, and I'm telling all of them, if you've always done your taxes on your own in the past, this is a good year to make that change.
Yes, that's going to be the wise advice.
It would be not only reckless, I think reckless and dangerous to try to do your own taxes this year, because even the preparation software, TurboTax and things like that, the IRS is still, as of mid to late December, still making clarifications on some of the tax content of the Tax Act. So you're buying software that is automatically out of date. So I'm claiming that every bookkeeper, accountant, and tax preparer needs to know this because they will cause change to every tax return you're doing, beginning this year, 2018, but going forward also.
And as you mentioned there, it's going to change even the bookkeeping systems that we've been using, the chart of accounts and so forth.
Sure is.
It's going to be fun.
We're going to get into that. The original bill that was passed by both houses of Congress was over 1,000 pages long. It was later condensed to only 500 or few more than 500 pages when it was passed into law. That's still a whole lot to get your arms around. This is my 60-page executive summary. It's organized to be clear and easy to use. It's comprised of nothing but bullet points and key phrases. It covers all 53 tax changes, but it gives you bullet points and key phrases instead of the entire thing. So you can get the entire bill. In fact, if anybody has trouble sleeping, let me know and I'll send you a link to download the entire tax bill, Tax Cuts and Jobs Act. But short of that, if you just want a condensed summary, this is it. This is something that even your clients can use and understand to help them understand the tax deduction changes they've been already subjected to for all 12 months of this year, but didn't even know about. So this is what I call, if you're old enough like me, you'll remember Cliff Notes from college and school.
I do.
This is the Cliff Notes version. This is the Cliff Notes version, Roger.
You just need to make the book in yellow next time.
Yeah, right. You're right. So here's the fact: we're dealing with small but home-based business owners. That's the category that qualifies for more deductions than literally any other change of taxpayer in America. And some of these deductions got even better with the 2018 Tax Cuts Act for small business. So here's our agenda for today's briefing. First, we're going to look at, we're going to review the key Tax Cuts and Jobs Act. I'm going to call this Tax Act for the rest of this briefing if we can. Review the key Tax Act changes to the 6 biggest tax deductions that most small business owners are using or can take advantage of, including accounting changes. So then we're going to take a look at, we're going to go through a list of other Tax Act changes that do not directly affect business, but many of which, most of which, indirectly affect small businesses, but certainly affect every one of your individual tax clients. And then finally, we'll spend a few minutes discussing what you can do now to get your clients educated, get them up to speed, not just you, but them up to speed about the 4 dozen new tax changes.
Now, real quickly, one of the things that I think is important about that is these are the 6 must knows, needs to know, both as an accountant and as a tax preparer. So this is, I think, very unique in the sense that you're going to take those 53 and highlight 6 specifically, and then we'll cover the others as well.
Exactly. Now these aren't just 6. First, we're not going to cover just the top 6 tax changes. We're discussing the tax. We're going to cover the tax deductions, the
Mhm.
6 biggest available to small and home-based business owners. There are probably 100 or more tax laws that are beneficial to small and home-based businesses to encourage them to get into and stay in business. But we're going to cover just a half a dozen, just 6 of the biggest ones, and your clients ought to be taking advantage of every one of these 6. And a lot of them are not, just because they don't know about them.
Mhm.
Just using these 6 can usually save your average tax client, even somebody who's just started a business, at least $3,000 to $5,000 in taxes. So we're talking big money. That's like adding another 3 to 5 grand to their tax refund, on top of what they're already whatever they're already getting. 80% of all filings result in a refund. So most people are getting a refund. Well, we can add 3 to 5 grand to that. Some of it, even though we're going to be dealing with it retroactively for 2018. These alone are worth more than all the rest of them combined. So I don't even teach the other 94 or whatever they are tax deductions, because those can be learned as you go. But 6 is enough for anybody to get their arms around. 3 is pretty much what most teachers teach in. They teach in 3s. I'm going to double that because you guys are smarter than most kindergartners, as the saying goes. And so we're going to look at just those top 6, all 6 of them. But these 6 will, again, I want to remind you, this is worth more than all the rest of the deductions combined. So what are the big 6? Well, the first one, we're going to talk about your business use of your personal vehicles. There are multiple enhancements to that as a result of the Tax Act. Then we'll look at out-of-pocket health expenses. That's been enhanced for us.
Mhm.
Hiring your minor children in a home-based business has been greatly enhanced. Then we'll talk about business use of your home. Fortunately, there were no changes. This is still a great deduction. The tax law did not mess with this one. And this is perfect. This is one of the biggest ones. Business travel, again, no changes. Wherever business entertainment, it's gone. That entire category of business entertainment is gone. It's been rescinded. And I'll bet you're going to have a lot of clients, bookkeeping clients, accounting clients, and tax preparation clients who have no clue that all those receipts they've been collecting all year long, all that documentation they've been collecting for business entertainment ain't going to count. They're
Yep,
not
I
going to
think
be.
a lot of them are going to be in for a big aha.
They sure are. And it's not necessarily going to be a positive aha, but the good news is that one was replaced by a brand new one, a brand new tax deduction that only applies to everybody except C corporations. It's sole proprietors, LLCs, partnerships, and S corps. And essentially it lets you cut your taxes by 20%. Whatever tax you would normally have paid as one of these entities would be reduced by 20% because of this new tax change that we're going to talk about. So scorecard, out of the top 6, 3 got better. 2 good ones were left alone. 1 was shot out of the water, and 1 big one was added. So let's take a post Tax Act look at each of the big 6 deductions. These are the big 6 deductions, including the changes that were made in the 2018 Tax Cuts and Jobs Act. First, let's look at business use of personal vehicles. This one's huge. There were lots of changes in this one, all positive for us. Business use of your vehicle is one of the biggest deductions for most small and home-based business owners. This coming year, this current year, the deduction rate is 54.5 cents per mile. But in 2019, in a few days, it's going to increase to 58 cents per mile. So for every 1,000 business miles your clients put on their personal vehicle, they've got almost a $600 tax deduction. If they put 8,000, 8,000 seems like kind of a random number, but I'm told, and I don't know if this is true or not, but I'm told that an active small business owner probably uses their vehicle about 8,000 miles a year on average for business purposes. So obviously that's an average. It doesn't apply to everybody, even if it's true. But if it's true, then for 2019, we're talking about almost a $5,000 in tax deductions. So this is a big one we got to know about. Here are some of the biggest changes. Well, first, before that, what they did not change was the record keeping requirements. It's still simple. All they want you to do is make a record of the date the destination, primary purpose, miles driven. What day is it? Where am I going? Why am I going there? How far am I driving?
Yep.
And that's it. And I've got I developed a vehicle mileage log that you can get for free from Roger, and we're going to be able to download that and make copies of it. And I did not copyright it on purpose so that you can give it to anybody you want to, but it makes this easy. You get in your car, and when you start your ignition, the first thing you do is put on your seatbelt. Then you reach over and grab your mileage log and write down what day is it, where am I going, why am I going there, how far am I going to drive. Then we've got, let me back up a little bit. What am I doing here? All right. There we go. Let's look at depreciation and expensing for vehicle purchases. This has had some major changes to it.
Yeah, this is amazing.
Let's look first at luxury vehicles. Luxury vehicle is defined by the purchase price. Up through the end of 2017, a luxury vehicle is defined as any new vehicle costing more than $15,800 to purchase. The 2018 luxury vehicle definition is $50,000. Now, isn't that a little more realistic? Can you imagine buying a car for $16,000 and considering it luxury? Well, the IRS did. I guess they're driving some old cars, but now it's up to reality. Now it now applies to anything $50,000 or more. That's a 316% increase. Here's an example of what that will do for you. Let's say we bought a vehicle at $50,000 this year in 2018 or 2019. It's got to be purchased, and it's the year it's not the year it's purchased, but the year it's put into use. So if you get a client that has purchased a vehicle but hasn't put it into business use yet, it doesn't count until they put it in business use. But once they do, this is what flows. In the first 4 years, look at the right-hand column first. Last year, or in 2017, the first 4 years total depreciation would have been $13,000 and change. Now the middle column, 2018, you're now going to get $41,360, almost the entire purchase price of the vehicle will be depreciated in the first 4 years. That's a 316% increase in depreciation. This will be a massive help to a lot of your clients that are using their personal vehicles for business use. Mm-hmm. Expensing, Section 179 expensing, I'm sure you're familiar with that, sometimes also called accelerated depreciation. Well, good news is the annual deduction limit has permanently doubled to $1 million. Now, that's because it's talking about business. Look in the upper right corner. It says purchase of business assets, not business vehicles. So I've broadened, for this one slide, I've broadened the subject matter to business assets. So if you're buying heavy assets like I don't know, cranes or front-end loaders or earth-moving equipment, something like that, it's going to go way above the price of a vehicle. So business assets, hard assets of that type, you can now write off up to $1 million in Section 179 expensing. It's limited to business's taxable income, however. So if your business does not show $1 million profit, you can't take $1 million write-off. So you can only take the write-off for as much as up to $1 million, but as much as, but not more than your net profit. And after using Section 179 for a vehicle, they have to use the actual cost method of tracking their tax deductions. Most people have two choices. You can take the 50 in 2019, they can take the 58 cents a mile deduction and not keep any other records, just the where'd you go, why'd you go there, that kind of things. Or the other option is to use the actual cost method, which is write down every time you spend anything because you have a vehicle that you would not have spent without a vehicle. Therefore, that includes not only gas and oil changes and things, but also car washes and repairs and things like that. Yeah. So, but if you take the Section 179 deduction, you're required to use the actual cost method. You cannot use the standard rate method because the 58 cents a mile includes a portion of that is included for depreciation. You've already taken the depreciation earlier. That's the only downside. But I've got a section in my book that shows a 3-step simple process for taking what looks like, on the surface, looks like a record-keeping nightmare, keeping actual costs every time I spend money on my car, and I make it dirt simple for you and your clients.
Very good. Very good.
Now let's talk about bonus depreciation. This is interesting. The bonus depreciation limit has increased to 100% from 50. So whatever type of business asset you're purchasing, you now have the potential of deducting up to 100% of the cost. And look at this. It's not limited to buyer's taxable income, to the business taxable income or profit. you can actually apply the bonus depreciation, even if it causes your business to go into a net operating loss. So remember the first one, the Section 179 accelerated depreciation, you're limited to your business profit. This is not. So a bonus depreciation can put you into a net operating loss, which could have lots of different kinds of values to businesses. And it now applies to both new and used property. Remember I said before it was just, it was new property. It's now new and used. And finally, the bonus depreciation on luxury vehicles is limited to $8,000, but that's $8,000 more than we had a year before. So that's not too shabby, right?
Mm-hmm. Very
now
good.
let's look at heavy vehicles. What are they? They're trucks and vehicles that have a gross vehicle weight of 6,000 pounds or more. Now, how do you know if your vehicle weighs that much or not? Open the driver's side door and look in the door jamb, and you'll see a sticker there. And somewhere on that sticker, it'll say GVW, gross vehicle weight, and it'll give you the amount. If the number is 6,000 or more, then you qualify for this one. It's a heavy vehicle depreciation. It applies to most SUVs, or many SUVs at least. Some crossovers even are heavy enough. Limousines certainly are. In fact, this law goes back several years and was originally passed by the lobby for the limousine business to get special tax deductions for limousines. But then it's been expanded to anybody with a vehicle that weighs more than 6,000 pounds. And of course, that includes Hummers and lots of other vehicles. So either trucks or vehicles having a gross weight of 6,000 pounds or more qualify for this special deduction. What is this special depreciation? Here's an example. And the tax code is cited on the right there. If those of you are tax preparers may want to jot that down.
Yes.
This is the source. Your vehicle cost, let's say it's $100,000. I don't know many vehicles are worth that you can pay $100,000 for, but there are some. But let's take $100,000 because I like mental math. I like round numbers. It makes mental math easy. So what are you going to do? First, you're going to take 25 grand off for Section 179. It's Section 179 expenses. Then you're going to depreciate the other $75,000 because you can go up to a maximum of what? How much? 100%. That leaves you a remaining basis of what? Zero. So you've now written off the entire cost of the heavy vehicle on the day you drove it off the lot and put it in business. Now that's assuming 100% business use and at least 50% business use. So if you got a client that uses this heavy vehicle, say for 60%, then they'll get 60% of these numbers because the business cost of the vehicle is only 60,000, not 100,000. So these numbers get scaled up or down proportionally to how much it's used for business. So the more they use it for business, the more deductions they get. You want more information? Here are the two main sources. The Tax Cuts Act that I mentioned, the 60-page executive summary, pages 43 to 48 refer to this particular deduction. And Chapter 8 of Windfall Tax Savings Approved covers this in some detail. At the end of this briefing, we're going to give you a big discount on these if you decide you want to buy these books. But I'm not going to try to sell them right now. I just want to give you the info. The next one we're going to look at is big out-of-pocket healthcare expenses. This is humongous. You know, I read some numbers like 2 days ago that said if they look at the entire spending on healthcare in America and divide that by the number of American taxpayers, it works out to well over $10,000 per taxpayer.
Oh, brother.
So we're spending a lot of money on healthcare. But if you got clients that do not have a small or home-based business, let's look at that category first. What do they get to deduct on their tax returns? And the answer is pretty much nothing. We're going to come to one minor exception in just a minute, but pretty much nothing. Even if they do have a home-based business, how much do they then get to deduct of their family's health expenses? Well, it's going to surprise you, but usually it's only the monthly premiums. That's not that much. But see, it's here on Schedule under Schedule 1040 or your Form 1040, line 29, self-employed health insurance deduction. Now they should say employee health insurance premiums to make it clear, because a lot of taxpayers get line 29 wrong. But this is only the monthly premiums. It doesn't include anything else. Now we could deduct some other out-of-pockets, but you got two little obstacles to deal with if you try to deduct any more than just nothing as a non-business owner or anything more than your premiums for business owners. Here's the two little obstacles. First, the only form they can use to calculate or claim their out-of-pocket health expenses is a Schedule A. That means they're forced to itemize their miscellaneous deductions. They cannot use the standard rate method or anything else, the standard deduction or anything else in order to claim deductions, because this is the only form it's on. But the problem with that is this: a solution was a problem. The problem slash solution is standard deduction doubled this year.
Yep.
It's now 12 grand for singles and married filing separately, and 24,000 for marrieds filing jointly. Now, when you start a home-based business, a lot of your personal expenses get converted automatically to become tax-deductible business expenses. So that gives you less stuff to put on Schedule A. So a lot of small business owners are not even using a Schedule A. They're just claiming they're putting everything on that they can on Schedule C, and then taking the standard deduction because it's more than they would have gotten on the Schedule A. But now they've doubled the standard deduction, so they're even less likely to file a Schedule A.
Yep.
And why is that a problem? No Schedule A, no health deductions. So they could deduct nothing more than the premiums if they don't file Schedule A. Now, there's a second little problem. That's what we call a 7.5% threshold. That's for 2018. Starting in 2019, that number goes to 10%. It was at 10%, it dropped, it's going to go back again. What's that mean? Well, it's easier to give an example than to try to define this thing. Here's the example. A taxpayer has a household income of $75,000. What's 7.5% of $75,000? It's roughly $6,000. So that means if they claim all of their out-of-pocket health expenses on Schedule A, the first $6,000 of expenses don't count. They only get tax deductions and tax benefits from anything above and beyond $6,000. What's $6,000 in tax deductions worth? About $2,000 worth of tax refunds. So they're still forfeiting $2,000 worth of cash, worth of real money, if they don't file, even if they do file a Schedule A. So there's only one way I know of that they could potentially write off all their out-of-pocket expenses, and this applies only to small business owners, and only to business owners that have only one employee. But that's most small and home-based business owners, right? You have one employee or could have. That's the criteria. So you do that with a Section 105 plan, sometimes called a health reimbursement arrangement. That's the convoluted term the IRS gave it. It'd be a lot easier to say medical reimbursement plan like it used to, but it's a health reimbursement arrangement now, which is only to confuse it with a health savings account and health. They got three different three-letter acronyms for tax deductions for the health field, and they all look kind of alike, but they're not. This is the biggie. What is it? First, it's an employee benefit plan where the benefits are tax-free to the employee and the costs are deductible to the employer. So you're the employer. Let's say it's a husband-wife business. No, let's say it's a one spouse business. Either husband or wife owns it, and they hire their spouse. Okay, so the business owner is is you, and so the cost of implementing this benefit is deductible to the employer to you as a business deduction, and the benefits the employee receives, which would be your spouse in this example, are tax-free to the employee. Mm-hmm. So there are no taxes paid on that money by the employee, and it's totally tax deductible by the employer. Who can qualify for this? Well, there are three categories. You've got to have one employee. So how do you get one? Because it's an employee benefit plan. That's why one employee. We'll get more detail on that in just a second. But let's. There are three categories. The broadest one probably is the sole proprietor, who then hires his or her spouse as their one only employee. Now, sometimes you got people who don't have a spouse or don't have a spouse that could be employed for whatever reason. Yeah. You got two other options. You can form a C corporation where you're the only shareholder, then hire yourself as the only employee of that company. Once you form a C corporation is a separate tax filer from you as an individual. So there's an individual called Roger Connect, and there's Roger Connect Inc. And they file separate tax returns. So Inc. can hire the person as their employee. You can do the same thing with a sole member LLC. Sole member means you own it. You don't have not a partnership. You don't share it with anybody. If you have a sole member LLC, you have the ability, when you form that LLC or anytime after that, you can file an election form to tell the IRS how you elect to be taxed. Now, the default setting, if you don't file an election form, is you'll be taxed as a sole proprietor. Uh-huh. But if you instead file an election form and choose to be taxed as a C corporation, then your LLC can hire the owner as an employee. That's the only way you can do it if the LLC is taxed as a C corp. So it's very, very specific and very. These rules are rigid, but they're very clear.
Yes.
It's easy to follow. Here's how it works. Let's just take a few words at a time. The employer provides a tax-free fringe benefit. Time out. Tax-free fringe benefits are those kind of things that when you go to a new W-2 job, at the end of the day, after the end of the day's orientation, they hand you a employee benefits manual you take home and read. Then you come back to the HR the next morning and sign a piece of paper saying, I read it, I understand it, we're cool. Okay, that's employee, so it's a written document. The employer is going to provide a tax-free fringe benefit to the employee. What's the employer do? The employer promises to reimburse the employee for what? All out-of-pocket health-related expenses incurred by that employee, but then it gets better. And all other members of his or her immediate family, which of course includes you, the employer, and the kids. So essentially what happens is that, let's say you're a wife business owner, and you hire your husband as a part-time employee. You give your husband, and he only has to work a few hours a week to qualify, and pay a minimum wage. That's probably all they're worth. You pay them for a few hours a week, and that becomes an employee. They become a part-time W-2 employee, right? So when you do that, then you can give employer can give employees employee benefits, correct? So the wife gives the husband, who is now her employee, an employee benefit, which says, darling, as long as you're working for my company, I'm going to reimburse you for all non-reimbursed health expenses. That's anything that's not reimbursed by your health insurance plan or your employer that's out of your pocket. I'm going to reimburse you for all those expenses, anything you have during the entire year, including expenses of other members of your family, all members of your immediate family, all dependents, it would be called, the IRS would call it,
Yep.
as a business expense. So now it's no longer a personal expense, so it doesn't go on Schedule A, it goes on Schedule C. So it avoids two of the biggest problems. You file a Schedule C instead of a Schedule A, and you don't have the problem of 7.5% threshold. So you avoid both problems by using the health reimbursement arrangement. Here's the average tax savings from this plan. This is not a new plan, but it's been clarified in the Tax Act. Last year, I saw stats of more than 10,000 business owners who were using this plan last year, HRA plan last year.
Okay.
And their average tax refund, tax reduction, was nearly $5,000. 4,984 was the number. So this is a big deduction. What can you deduct? Well, let's look at some of the things that it's anything related to healthcare, just about. But just start with annual deductibles. I mean, annual deductible alone is thousands of dollars, right? That's the amount of money you got to pay starting January 1 of every year before your insurance benefits even kick in. You're out of pocket for $2,000, $3,000, $4,000, $5,000 before you ever get into your 80-20% sharing or your 100% deductible, whatever. You don't get any of that, no benefits from your insurance premiums until you hit your annual deductible, which is almost in every case is well over $1,000, and in most cases $2,000, $3,000, $4,000. There are high deductible plans that could be as high as $5,000 to $10,000.
Mm-hmm.
But look at I put some things in yellow here that are almost never covered under health insurance plans. Preventive care, they don't care to keep you healthy. They want to treat you when you're sick because it's all run by the. I won't get my bandwagon there. How about supplements, vitamins, supplements, nutritionals? They're never covered by health insurance plans, but they can be covered under your HRA under the right circumstances, which you can set up. Elective procedures, wellness care, they don't take care of wellness. Homeopathic care, holistic treatments, that's never covered. Even things like, say, orthodontics. If you got a kid that needs braces, you're talking about probably $7,000 to $10,000 start to finish. Many insurance plans don't cover that at all. They don't consider it to be a required, it's not medically required procedure.
That's right.
That's because they don't want to pay for it. And if they do cover it, it's usually capped, maybe $2,000 or something like that. So you're still stuck with the other $5,000 to $8,000 worth of expenses. It's all can be reimbursed under the health reimbursement plan. Now, all an HRA is doing for you is letting you pay for all of your health-related expenses in tax-free dollars. that gives you roughly a 30% savings from what you would you'd have if you paid out of pocket.
Yeah, because you're deferring it now to the employer, and the employer is picking it up as a reimbursement.
Exactly, and the employee gets to write it off as an employee benefit because there's a line for employers called wages and benefits, and so the benefits go in there. So and this deduction can put a business into a net operating loss. So if you only made $4,000 this year, but you put out $10,000 in reimbursements under this employee benefit plan, then you're looking at claiming a $6,000 loss. That's good for business, right? So more info for your tax preparers. Check out tax code section 105. It's all spelled out there. Those who can't read the tax code because it's a foreign language, you can go to deducthealthcost.com. There's a short video briefing there that will give you the details on the ins and outs of. I've just done a broad brush treatment here, but it'll give you specifics, enough specifics to know whether this plan is right for you, and if so, how to proceed. Mm-hmm. It's also covered in chapter 7 of the book, the Windfalls book. Okay, moving along. How about hiring your kids to work in a home-based business? Now, this is a tax deduction that's not well known and not well understood. The truth is any child 7 or older can qualify because they're exempt from child labor laws. The child labor laws, those are the laws that say for certain kinds of jobs you have to be at least 14 to do it. Most of them say at least 16. There's some that say at least 18. Mm-hmm. That's because the purpose of child labor laws is to protect the child from dangerous working conditions. So the courts have ruled that a child working for their own parent in their own home is presumed to be working in a safe working environment, and therefore the child labor laws don't apply. As long as you hire your own kids working in your own house. There's specific requirements for doing this, but they're really easy to follow. I spell them all out in the book, and it's a little checklist. You go through the checklist, and you'll be IRS compliant then. But here's the deal: up to 100% now, up to $12,000 now. The reason I put asterisks and put that in green, because this is a change due to the Tax Cuts Act. The limit, the amount that can be earned by your child tax-free was and continues to be equivalent to the standard deduction. Well, last year's standard deduction was around $6,000. This year's standard deduction is exactly $12,000.
That's right.
So you can now literally pay your kids up to $1,000 a month per child per year, tax-free. And the wages you pay them are tax deductible, right? Wages and benefits are deductible. So you give your kid the wages, it's deductible to you, so all money is transferred tax-free. You don't pay taxes on the money because you deduct it as wages. The child doesn't have to claim it because it's tax-free up to $12,000 a year. Now, if they made more than $12,000, they'd only pay the minimum taxes on the amount above and beyond $12,000. So it's not even a problem if you go slightly over that.
Yeah.
Now, there are some requirements, but you know, they're specific. So here's the big plus, though. Your children are going to earn money from you, right, as a business expense. How are you going to pay them? Well, if you're smart, you're going to pay them the way businesses pay their employees, with a business check. Have you ever worked for a W-2 employee that came around and handed out cash on payday? They don't do that. And they don't give you a personal check on payday, right? They give you a business check. So you want to treat your business like a business. Pay them with a business check. Now, you give your 7-year-old or even 17-year-old a business check, what are they going to do with it? Nothing, because they can't have a bank account. Not yet. Not until they turn 18. But what you do is you set up a custodial account where you're the custodian. It's their account, but you're the custodian. That means until they turn 18, only you can move money in and out of that account. So you can use the money earned by the child, still controlled by the parent. Here's where you can get more details. Let me back up a minute and talk another word or two about that, if I may, Roger.
Yeah, please.
What can you use this for? Child earned the money, but you can use it. What can you use it for? Well, obviously you can withdraw some of it and give to them if you want to, and let them use it as if it were allowance, except they earned it. Allowance is a dangerous thing to do because it teaches entitlement. So I wouldn't recommend that, but that's a different subject. They're going to earn money from you, goes into this account. You control the account. What can you use it for? The courts have ruled, it's a very clear ruling. Anything that benefits the child except room and board. You can't charge them to live with you. You can't charge them for the food they eat. Anything else can. That means your child could earn their own money for their after-school sports equipment. They could earn their own money for their private tutors, earn their own money for extracurricular activities, earn their own money for their summer educational summer camp. And so all those kind of things can be paid for by the parent with money earned by the child with tax-free money. Now, here's an interesting thought. If your kids, if you employ your kids, and between the ages of 7 and 18, right, which goes to 24 if they're in school full time, if you pay them enough that they can put $5,000 a year into an IRA, and that IRA on average earns 10% per year, by the time that, and then they do nothing more, they save no more money the rest of their lives. When they're ready to retire, they've got more than $2 million sitting in that account by simply putting in $5,000 a year while they don't have any expenses anyway because they're living with mom and dad.
Yep.
That's a pretty good deal, huh?
Well, but I think one of the things that you can also mention is the fact that you're probably buying for them shoes and clothes and shirts, and there's a lot of expenses that you're incurring that easily could be passed through to the child with them having the responsibility to get their own pants and shirts and so forth. And that in turn, I think teaches a valuable lesson, but at the same time was something that you didn't give to them as an allowance, as you mentioned. It's something that they earned and was part of the monies they were receiving because of the work that they may have been doing within the business. And
exactly.
So the pass through there is now through this tax system, and that's one of the things that you're now benefiting from because you're now seeing that as a wage. So yeah, this is a very good and important thing to be notating.
Well, I've got an hour-long webinar I do on this subject and all the benefits that go way beyond taxes. That I'll do at another time. I won't get into it now, but there are things like a small child, a 7-year-old or 10-year-old, is going to learn for the first time that the only way to get money out of the bank is not by slipping a plastic card into a slot in the window. It's by putting money in the bank before they get it out. So They learn that concept. They learn that shoes aren't free just because mom and dad pay for them. Maybe they're going to share it now. When my daughter was younger, I used this tax strategy, and I made a deal with her that if she wanted a cool pair of new designer shoes, I would pay the amount for the generic version. If she wanted the designer version, she could use some of her money in her business checking account, her custodial account, to pay the rest of it. And she had some decisions to make. Do I want to help pay for get them free and buy the generic one, or do I want to have the cool little N on the side for Nike and help pay for the cost?
Yep.
So they're learning real life lessons I never learned in school. Love this one. Next, let's look at business use of your home. This is one that I said before. The Tax Act left this untouched. It's a great deduction. I want to cover just a couple of key points to make sure everybody's up to speed on this, because some of these things have changed the last several years. You qualify if the primary administrative function of your business takes place at home. Now, there are 4 ways of qualifying. This is the easiest one, the default, if you will. Even if you have a storefront shop, let's say you own a flower shop. That's not your primary place of business. Your home is not your primary place of business, right? It's your flower shop.
Yeah.
But if you take all your paperwork home, if you do your ordering and your invoicing and your planning and your paycheck writing and deposits and all that stuff from home, the administrative functions, then you qualify to have a tax-deductible home office. That then technically makes your business a home-based business, which gives you a huge array of tax deductions. Now, you've got to use the area exclusively for business purposes and regularly. So if you pick an area you're going to use for business, it does not need to be a separate room, but it needs to be a room that's visually identifiable. And you've got to do only business in that area, and you got to use it on a regular basis. That second line, that third bullet there is to, because of taxpayers who said, well, we got an extra bedroom we're not using, let's just put a desk in there and take a picture of it, and we now have a home office. No, the IRS says you got to prove that you also work there on a regular basis. So at least 2-3 times a week, you got to have some evidence that you work there. Easiest way to do that, put a calendar on that desk. And every time you go to that desk to do some work, jot down the on whatever date on that calendar today is, and jot down what you did and how much time you spent. As long as you show some time spent 2-3 times a week on an ongoing basis, you got that one covered. Exclusivity, they got to kind of take your word for it. But beware that if they don't have any other way of proving exclusivity, they have the right to demand to come into your home and inspect your home office. So they don't. So on your desk in your home office, don't even have a picture of the family there. Think of this as its operating room. Make it absolutely sanitary.
Sterile. Okay.
Sterile, and take pictures of it. Because then the pictures then will provide the evidence, so they don't need to come into your home. Remember, I said if they have no other way of knowing whether this is really a home office or not, they can come into your home. Well, you have another way of knowing. You have my word, my statement, my affidavit, and you've got my pictures. That does it. The home office deduction, I got to change that. It's for years now. It's been called the business use of the home deduction. It's not home office anymore because it's way bigger than that. It allows you to convert a lot of your personal expenses to tax deductible business expenses.
Mm-hmm.
We'll talk about some of those in a second. The deduction amount is a business use percentage. So if you have let's use round figures again, you have 1,000 square foot home, you're going to use, say, 200 square feet for your business exclusively and regularly. You've got a 20% business use percentage, BUP, right? So suddenly what happens? 20% of your rent. Yes, this is the only place in the tax code the renters get a tax break.
Yep.
If you're a renter, you can write off 20% of your rent as a business expense and and pay that 20% with tax-free money, and then pay as out of your take-home pay only the other 80%. You can write off 20% of all repairs, utilities, utility replacements, a new furnace, new air conditioning. All those kinds of things are 20% deductible if 20% of your home is used exclusively and regularly for business purposes. So this can be a huge benefit, thousands of dollars worth of benefit to a lot of people. And you don't have to be home-based in a traditional sense. You don't need to be, say, a network marketer who's working out of your kitchen or whatever. You can take it out of the kitchen, put it in an area that looks like a business space, because a separate room is not required. You do not need it. The old tax law used to say a home office need to have at least 3 walls around it. That's how they described an office. Not anymore. Now it says it needs to be a visually identifiable space. What's that? Let's say you've got a one-room efficiency apartment. In the corner of that one room, you put a desk or a table. You put a chair against that table, and you put a little stand next to it and put a printer on it, put a computer on that table, put a chair up against it. Now, if somebody walks into your front door and they look around your room, what's that going to look like? An office space, right? It's a visually identifiable space, visually identifiable as being business. So it doesn't need to have walls or plants or any kind of a border around it. So you can deduct the square footage that's occupied by that desk and chair and what have you, and a reasonable amount of walking space around it. That's a quote from the tax code. So it gives you a nice deduction even if you don't have a spare room you can use. And finally, the deduction is claimed on Schedule C with attached Form 8829. So 8829 is the form called business use of your home, and that's where you put down all the details of how big your home is, what percentage is business, et cetera. That's where you sign saying it was used exclusively and regularly, all that stuff. So this is a big deduction a lot of people are losing out on, either because they think it's unsafe, which it used to be. It used to be a target of audits, but that's been at least eight or 9 years ago now. So if you're up to date at all on this stuff, you know that home offices are not, I mean, would they have a separate form called business use of your home if this was a dangerous deduction? They simply want to make sure you're doing it right. So this deduction is worth a lot. And the other reason I want to say, a lot of people just think it's risky. They think it's risky, or they think they don't qualify because they really run a flower shop. And how can I be home-based? Or they don't understand that that they can use any visually identifiable space for an office. It does not need to be a separate room. So a lot of your clients are misleading themselves, and you might be able to enlighten them on a big new tax deduction they don't know they qualify for.
Or get things in order so that they can qualify for it.
Exactly. This is one you cannot qualify for retroactively.
Yes.
You can't in March do their 2018 tax returns and go back and make up a home office.
But in tax planning, one of the things that we can do is bring to light the fact that if they're already doing half that effort as to going home and working from home, well, let's go ahead and designate a space. Let's go ahead and get a few things in order so that this year we can qualify for it. So
exactly.
I like there is both the tax planning and the tax preparation. I jokingly say that it's December 31st that distinguishes the two, but essentially it's when you're in the tax planning mode, it's knowing these things. How can you get things in order so that you qualify? In the tax preparation, it's preparing the returns, and it's simply making sure that we actually qualify and don't push things too far, and then basically do this legally. So yeah, I really love this thing. This is something that is, I think, sometimes overlooked and misused. So.
It is, and you just said something that kind of triggered something in my mind. I used to think of tax planning as being an oxymoron because Congress changes the tax laws so often that you can't do much planning. But this is one you can plan on. This is one that even survived without being touched. The Tax Cuts and Jobs Act changes.
Well, that's true. I could see the oxymoron part of it, but well said on that.
Okay, the more info, page 26 of the Tax Cuts Executive Summary, and chapters 3 through 5 of Windfall Book. Now, tax deductions for out-of-town business travel. Let's take a look at that one. This one also has not been touched by the Tax Cuts and Jobs Act. In a few minutes, I'll talk about one thing that happened. It was in the act that they thought might affect this, but turned out it does not. So taxpayer can still, if they know the rules, they can still combine business and pleasure and write off most of it. They can still set up a vacation as a largely deductible business trip. They can still claim a family reunion as a business trip and get tax-free haircuts, manicures, and dry cleaning on business trips if they know the rules. So obviously, what do you think? Where do they learn the rules? Oh yeah, here they are. Page 42 of the Tax Act and Chapter 9 of the Windfall Tax Savings Book. So nothing has changed regarding business travel. It's just as good as it was before. And if they understand the rules, which most people don't, then you can get a lot more tax benefit from this. The key word is planning. You've got to set up the trip properly in order to have what would have been essentially a vacation and have it be tax deductible. You cannot come back home and say, I stood in line at Disneyland and talked to some other people about my my network marketing business and recruited somebody so I can write off my trip. No, it didn't work that way. You got to plan it correctly and know the rules. So let's teach them the rules. Rules are laid out in Chapter 9 of this book. And it's all plain English. Now, some of you tax preparers may think plain English is beneath you, but it's for you. I wrote this for your client, not for you. But for you, I put the tax code reference right in there with every single tax deduction that I talk about.
Well, just to clarify, I think, yes, as a tax preparer, it's probably better for you to know the nuances of it, but you still need to communicate this in a way that your clients can understand it. And so sometimes it's great to have this type of a background because then you're able to communicate it effectively because you know the layman terms to use. So that's important.
Yeah, because a lot of tax pros that I know don't speak English. They speak whatever it is, taxis or IRSEs or legalese. So this makes it something. It's a user language. So you can just give your client this information like verbatim, and they can get it.
There you go. They speak geek.
They speak geek. Okay, let's look at business and entertainment. Whoa, what the heck happened here? Business and entertainment deduction. One of the biggest, most popular deductions for small and home-based businesses has been eliminated. Gone. Retroactive to January 1st of 2018. So if you got clients that have been collecting their receipts and documentation for business entertainment this year under the laws that were in effect in 2017, they're going in for a rude surprise. Almost none of their business entertainment will be deductible. So in one category that can be, we'll talk about that next. Who saw that coming? I don't know a single tax pro, guru, anybody who saw that one coming. It's such a popular deduction. But apparently, the tax writers decided, this is what they said verbally, and what they meant might be different things, but verbally what they said was that it's not right for an ordinary taxpayer to have to underwrite the costs of business owners wining and dining people. So let them pay that cost with after-tax money.
Very good.
What they also said was that we're going to double the standard deduction, so you're not going to need this as much. So there's an attempt at balancing that a little bit. So the entertainment expense category is gone. That will no longer will appear on Schedule A Schedule C will no longer have meals and entertainment. That's gone. It'll just now say I think it's going to say business meals. I've seen a draft of the new Schedule A. I haven't seen the final thing yet. But here's the deal: some meal deductions live on. They survived. When Congress passes a big piece of legislation like this, 500 more pages, what they tend to do is the tax writers, members of Congress and Senate, they paint with a broad brush. They say, here's what we want to change. We want for entertainment expenses to disappear. And so that's what they're writing into the tax law. They don't say how to do it. They leave the how-to part to their senior staffers, who later, they working with the IRS, will then issue rules, clarifications, regulations, et cetera, to fine-tune what's already in this massive 500 plus page bill or tax act will become larger with the definitions. Now, definitions, as Roger said, this was passed in late December of 2017. It's been passed more than a year ago. And yet in late December of 2018, the IRS is still putting out clarifications, rules, and guidelines for how to use some of the content of the Tax Cuts Act. So the jury's still out on a whole lot of things, meaning they haven't ruled yet on a lot of them. Some they've issued temporary guidance, which may or may not become final. But temporary guidance is good enough for filing 2018 tax returns. They may change it, they may clarify it and change it for 2019.
Yep. So
we're still looking for clarification and guidance on a lot of things, but here's what we think we know for now. Now, you bookkeepers and accountants, pay attention to this because this is going to mess with your minds. First, what's deductible for business meals? Well, are business presentations and business discussions during meals deductible? It depends on what the primary purpose is. Did you take me out because I'm a nice guy and you want to have lunch with me, and while we're out we talk business? If so, not deductible. That was an entertainment expense, not deductible. If you took me out because we're going to talk about our new plans for next year, and start to map out some goals and objectives for next year, and we're going to do that over lunch, the primary purpose was business, which means it's now it is deductible. Still only 50%, but deductible. Category 2, employee meals while out of town. But it's still 50% as before. So that's like your business travel expenses. You always got to deduct 50% of your meals before, or use per diem in some cases, and you still can. Nothing's changed there. How about employee meals on site? If they're provided for convenience of the employer. Now there were sometimes let me think of an example. Let's say you're a very small business. You've got maybe 4 employees in your small office, and you every day one of them on a rotating basis gets hit with a phone watch during lunch hour. They've got to stay to watch the phones, and they don't get to go to lunch at from 1 o'clock, 2 o'clock. Instead, you either buy their lunch for them, have it delivered, or you let them order it and get reimbursed or whatever. So if it's for the convenience of the employer, not the employee, it is still 50% deductible through 2025. Then it becomes non-deductible unless the laws change to make this permanent, which they probably will. Number 4, this is only number 4 different. This is still meal expenses. What's deductible? De minimis, food, snacks, and coffee. Now, what's de minimis mean? That's a legal term. It's actually a Latin term, which I translate as meaning ain't worth much. These things that aren't worth a lot of money. We're talking about here donuts on Mondays, and muffins on Wednesdays, and coffee all week and stuff like that. As long as it's available to the entire staff, and it's de minimis, it's minor in terms of the grand scheme of business, then they are now 50% deductible to the business owner. That is down from 100%, but the jury is still out on this one. They haven't done a final ruling. Tentative ruling is 50%. It may go to 100% deductible to the business, and none of it is imputed income to the employees. Number 5, holiday parties, picnics, summer outings, things that occur occasionally for the primary purpose of employee morale and bonding and things like that. 100% deductible for those. Number 6, business meetings of employees, shareholders, and agents or directors. So if I call a meeting of shareholders, for example, and during that meeting we also serve lunch or cocktails or something, then the refreshments are 50% deductible for a meeting of employees, stockholders, agents, or directors.
Okay.
Then we got number 7. Food and beverage items provided to the general public. An example of that would be a real estate open house, where you might have some bowls of nibble food here and there throughout the house, and you may eat some of that nibble food as well. Well, if it's available to the public, it's 100% deductible as before. That has not changed. 8, 2 or more employees having a working lunch with each other. Now, this isn't you having a working lunch with your client, which used to be called entertainment. This is two employees going together, going to lunch together to figure out a problem or a situation that they both need to resolve, perhaps for a client or a customer, for example. That is still 50% deductible as before. On-site cafeterias for employees, provided for convenience of the employer. Here's a real example. I once worked as a vice president for a McDonnell Douglas corporation in St. Louis, and they've got this humongous building out right next to the airport, main airport of St. Louis, and it is pretty difficult for employees to get out of that building, get somewhere for lunch, eat lunch, and get back within an hour. So McDonnell Douglas set up an employee cafeteria, and they subsidized it. So instead of paying $10 for lunch, I pay $5 because they paid the other $5 or less. So they set up a subsidized cafeteria for their convenience. Why? Because their employees could get back to work within an hour. It was easy if you just went to the elevator, pushed the button for floor number 4, and got off in the cafeteria instead of driving somewhere to a remote location. That is now the part that is underwritten by the company is 50% deductible. The subsidized portion is 50% deductible to the company. There's no imputed income to the employee. Number 10, offsite. If it's an all-employee mandatory attendance meeting, it's 100% deductible. So you may decide you're going to have some meeting offsite. Everybody's got to come. It's for everybody. It's required, and you're going to be serving food and beverage there. In that case, the food and beverage will be 100% deductible because they're required to go there. Now, how's that with messing with your chart of accounts, huh?
As an accountant, I could see us having each of those as subcategories.
You've got to, because, and all of these we just went through, all of these 10 different types of meal deductions are all tentatively determined to be non-deductible, 100% deductible, or 50%. You've got to keep them separate, so because you don't know what you're going to have to end up, what percentage you'll have to end up using later.
Yes. So
this will mess with your chart of accounts, that's for sure. And your clients probably have no clue, therefore they're not keeping good enough records, and that's a separate issue we need to deal with. Now the new number 6, replacing the entertainment expense, is this one. It's for pass-through entities, which is everything except C corporations. It's sole proprietors, S corps, some limited liability companies, and some partnerships. That's what's covered. That's who's included. What are they included in? They're included in a brand new, never before tax deduction that gives them a 20% reduction in the taxes they pay on all qualified business income. That's a new made up term we'll come to in a second. So if you accountant or you tax preparers, the tax code section, it's a new section of tax code, section 199A, which covers this. It was put in the tax code only after passing the Tax Cuts and Jobs Act. It's a brand new, never before deduction. That's why this is a big deal to a lot of your clients. They've never been able before to do this. For the most part, these are called pass-through entities, right? Why are they called pass-through entities? You tax pros know. It's because the income earned by the company passes through to the owner for tax purposes. Mm-hmm. Now it's so they never get any benefit from like the corporations do, where you can get different kinds of deductions. But it's a section 199A now is available to pass through entities as like a parallel benefit. So they said, look, we're dropping the C corporation tax rates to a flat 21%. We should do something for small businesses too, because Congress really is committed to small businesses. Why? Because it's the backbone of the American economy, for one thing. So it's made official in this tax code, never before happened, big deduction now for your clients. What's it mean? You can write up 20% of qualified business income. What the heck does that mean? Well, this is the IRS we're talking about. So it means the same thing as net profit. After business deductions are taken into account, what do you do with, what's a business do? They count upon how much money they got, how much money they spend on the business, and how many tax deductions they get, and the amount that's left is our net profit, right? It's the same thing. It could be as a net profit, except it only applies to one category of businesses. How do you calculate the 20? We're going to discuss that in the next slide. But 20% of QBI deduction, what is that? How do you calculate it? It's really pretty simple so far. Notice in italics there it says, so far it looks like the process is going to be, you determine your KPI, which is your net profit. We talked about that above. Determine the taxes owed on that profit by using the tax tables, and then slash that number by 20%. And the result, your final taxes for the year. So although this is called 20% tax deduction, it's really a 20% tax reduction. You figure taxes you would have paid, chop off 20%, and that's how much you end up paying. Now, who gets hit by this? There are some restrictions, but I want to emphasize these only apply to people who meet two criteria. You got to meet both of them. Either or, not a problem. Everything I just talked about applies. But if it's both of these, then you got some restrictions. The first requirement is restrictions apply if you earn as a single more than $157,500. As a married, filing jointly, above $115,000. So if you're what they call a high income earner, which is above one of these two numbers, then you've qualified for one of the requirements for getting yourself restricted. There must be a better word than qualified for this. So you just put one foot in the grave. Let's go on and look at category B, which you have to earn a lot of money and also be working in a service trade or service business. That's things like healthcare, consulting, legal services, performing arts, architecture, accounting. You can read these words. These are the kind of things that are called by the IRS service trades or service business, and they're defined in the tax code. They are redefining those, making the scope a little narrower for purposes of the Section 199A changes. But if you meet one of these requirements, if you're a high income earner and you're in one of these businesses, or if the principal asset of the business is the unique reputation or skills of you, the business owner, or the employees, you also kick in. So if you're not in the healthcare business or legal services or something, but people come to you because of your reputation, your unique reputation, or the skills, the fine skills of your company, and the reputation of the company, or either you or your employees, you fall into this category. What's a specified service trade or service business? The common denominator looks to me like it means it's businesses that in the end do not produce a physical product. If we think about that, if we back up to the slide and look at healthcare, consulting, performing arts, now there's no physical product produced there. Even if the principal asset is your reputation, it's still not a physical product. So that seems to be the common denominator, but so use that as a guideline, but not a rule. And hopefully someday the IRS will get around to finishing their refinement of the definition of service trade or service business before the end of the year, and they're getting pretty close. So bottom line is this: restrictions on the 20% tax benefit apply only to taxpayers who are high income earners and who also are in a specified service trade or service business. And if you're in both those two categories, don't go to your accountant for advice, go to your tax preparer. And don't come to me because I'm not getting into this. Because you know what, the people who analyze these tax bills have said that up until this point, the 20% deduction, up before we kicked in restrictions for A and B, this was one of the easiest tax changes to understand. Once A and B both click in, it becomes one of the most complicated tax deductions ever. So don't even, I say boys and girls, don't try this at home. And again, here we get, it's on page 33 to 36 of the Tax Cuts Act is where all the changes are annotated, or you can get the full thing in chapter 10 of the Windfall Book. Okay, that's the top 6. Now those 6 tax deductions for a home-based business owner or a small business owner who can qualify to be a home-based business owner by doing administration at home, those 6 will give more than half of the tax breaks they can get, even if they learn all 100 of them. But it's not all of them. Those are the changes. I've just gone through the changes that directly apply to those big 6 small business tax deductions. Let's look at a dozen or so of the other ones that also relate to businesses in most cases, or many cases, but not directly to them. For example, the personal exemptions, eliminated. That was worth $4,050 last year per member of the household. If you had a spouse and 2 kids, you just got, what they'd be, $13,000, whatever. I told you middle math isn't my subject, but you're going to get 4 times $4,050. This year, you get nothing. It's eliminated. You're going to have clients calling you saying, what the heck happened to my personal exemption? You left it off this year. No, that's because it's not allowed anymore.
Yep.
Instead, you got a double standard deduction. Child tax credits, that's doubled to $2,000 now, $1,400 of which is refundable for low income earners. C corporations, I alluded to this earlier. The tax rate used to be a stair-step tax rate, like most other taxes are, going up as high as a tax rate of 36%. But now, C corps now pay a flat tax at 21%, which makes all C corps competitive in the world market, and makes a lot of small businesses now able to compete with foreign services on a level playing field. Section 129 plans. These are where you can sock away tax-free money to help pay for the cost of schooling. It now, the clarification is it now also applies to K through 12 private and religious education. It used to be only public education until this year. So if your kids went to education that was not private or religious was excluded, it's now included. So you can use this Section 129 money, tax-free money, to help deflect the costs of any kind of K through 12 education. In 401ks, people with 401ks and lose their job, generally if they borrow money from their 401k, up until this year, they had to pay it back within 60 days, or else they get hit with a tax penalty and interest.
That's right.
On a borrowed amount of money. Well, that's changed. The payback deadline now, if you're a job loss, if you lost your job or lost your plan, either one, and you have to borrow money from it, your new deadline is the next tax filing return due date. Now that's as of when you took it out. So if you take money out on January 2nd of 2019, that won't be due until April 15th of 2020.
Yeah.
But if you took it out this year, you know how to do that. The deadline is whenever your next tax return is due from the date of withdrawal of the money, the borrowing money. So it gives them a lot more money to repay it without any penalties. There's no penalties, and there's no interest on that money. And C corps now exempt from AMT. No alternative minimum tax. Now, this is not in my slide presentation, but let me mention that the AMT rules for regular taxpayers is going to affect only about 10% of the number of people affected last year, because the limits, the caps were raised. So this start AMT, as you probably know, started off I forget what year it was, several years ago, as their attempt, as Congress's attempt to make sure the rich people didn't get by with paying no taxes. So if you work your taxes up and it shows zero taxes, here's an alternative way to do it. And that alternative way ended up producing millions and millions of dollars worth of additional income from average taxpayers, because of the clumsy way in which the law was written. But Congress scratched their collective heads and says, whoa, this is pretty cool. Let's don't change anything. So they didn't. And millions of Americans got nabbed in this thing. You had to figure your taxes 2 ways every tax year. And you had to sign a form on your tax filing that says, yes, I figured my taxes also under the AMT to see whether I owed more money. And a whole lot of people owed a lot more money because of the AMT. The AMT, the number came out bigger than it would have been otherwise. Well, now they've changed the parameters, and so they're guessing that the Office of Budget and Finance is now estimating that fewer than 10% of the people who were affected last year will be affected this year. This year meaning 2018. So you got to know about this one. Alimony, big change coming though, as of January 1, 2019. So this does not affect your tax returns for 2018. It used to be that the person writing the check got to write it off, right, as a tax deduction. Mm-hmm. The person receiving the check claimed it as income and paid taxes on it, right? Well, now as of 1/1/19, it's not deductible, not taxable. So if you're the person writing the check, the alimony check, you can't deduct it. The person receiving it, the spouse, the former spouse, is not taxable income to them. It's a huge change. So if you got anybody who's in the process of divorce, they might want to think about whether they want to drag their feet until after January, or maybe they want to speed up a little bit and do it before January 1st. This applies only to final divorce rulings that take effect on or after January 1st of 2019. Okay, that's a clear, even though this was passed in 2017, not effective. This is one of two tax changes that won't be effective until 2019.
Yeah.
Casualty losses, big change here. Somebody has a house burned down. They've got fire insurance for, let's say $400,000, but their house is worth $500,000. They can write off the other $100,000 on their Schedule A, right? Nope, not anymore. Now casualty losses are deductible only if they're in a federally declared disaster area. Federally declared means federal, not state. Usually the first thing that happens if there's widespread flooding in a large town or something is the governor will claim claim that as a disaster area. All that means is it gives the state the ability to give you money to help rebuild, but it doesn't give you the ability to write anything off on your tax returns. A federally declared disaster area gives you that ability. So only if your casualty loss is due to a federally declared disaster area is any deduction available on your tax return. So rule of that is, the lesson in that is make sure you got the best fire insurance, earthquake insurance, all that kind of stuff you can afford, because Uncle Sam ain't gonna help unless it's a federally declared disaster area. Dependent care plans. This is a clarification. They've now clarified that yes, this does apply to self-employed working at home. So if you're a stay-at-home mom and also have a home-based business, it's kind of hard to get a lot of business done with two toddlers running around. So you can bring in caretakers and use your dependent care plans, your tax-free money, to have dependent caretakers take care of your kids for a couple hours a day while you go into the home office and close the door and do work. So that was unclear before. Some assumed it was, some assumed it wasn't. Assumption no longer allowed. It now applies. Non-reimbursed employee expenses. This is kind of big. This is on Schedule A. These are employees. These are 1099. I mean, these are W-2 employees who have expenses due to their business. Like the boss asking, will you pick up some office supplies on your way to work tomorrow because there's one on your way or it's close by or something like that.
Yeah.
And you pick it up, but you don't get reimbursed mileage for that. Or maybe they forget you pick up staples and they forget to reimburse you for the staples. You can write all those things off as non-reimbursed employee expenses on Schedule A. Well, not anymore. As of the 2018 tax returns, that line will be missing from Schedule A. No longer deductible. So what should your clients do? What they should do quickly, remember this applies to all of last year. So if they incurred some expenses during the past year that they don't get to write off now in taxes, they kind of deserve to be reimbursed, right? So you might want to go to their bosses and say, here's something that's changed that I wasn't aware of, were you? And I'd kind of like to ask you to reimburse me for the expenses that I would have claimed my Schedule A, but I can't now because they're still deductible to you. And going forward, can we just simply have a different kind of an office policy where I get reimbursed when I spend my own money for business benefit? That's a big change for some people. Parking and transit fringe benefits. This was big. This let companies, employers, pay employees up to, I'm not sure the number. I think it's $320 a month. I'm not sure. Don't hold me to that. But a fair amount of money that the employer could pay to give the employee a parking space. They could also reimburse them up to, I think it was $120, something like that, for those employees who commuted by mass transit. There's even one where they could pay them up to $50 that commuted by bicycle. Those and it's tax deductible to the business owner, tax free to the employee. It's still tax free to the employee, but the business owner can no longer deduct it. What's that going to do? It's going to cost some business owners to say, well, I can't pay that parking ticket or your transit fee anymore because it's not deductible. So that might be something you want to negotiate with your employer before. Some of your employers may not even be aware that the parking and transit fringe benefits they paid this year are not going to be deductible to them on their tax returns for 2018.
Well, it's going to affect, I think, a lot of the way the compensation plans have been built. I'm assuming that these were benefits or perks that they were included within the compensation because they had that ability. Now that's going to be removed, and all of a sudden it's in essence going to be a cost that they may not be able to bear any longer.
Exactly. And if it's an employee benefits manual, that's a legal document. So now we're talking about changing the legal wording of the structure around the business. This is not a small deal. It's a big deal. But right now, the employees can, if they got $320, if that's the right number for parking, they do not have to claim that as income. It's not imputed income, as they say in tax circles, but it is deductible to the businesses, but no longer. It's still not imputed income, even if they continue paying for it. If they paid you for parking all of 2018, and then they find out they can't deduct that, they've still paid you, and you still get the money tax-free.
Yep.
Next, state taxes. The federal exclusion amount has now doubled. This won't affect everybody, maybe not many people or anybody in this call, but it's now doubled to 11.2 million. That's the amount of money that you can leave to somebody else tax-free. Above 11.2 million, you got to pay taxes. Now, I know this angers a lot of people, because what you're doing is you're paying taxes on money you earned and paid taxes on. Now you're going to pay taxes on giving it away. That makes no sense. But I have to remind myself, you cannot apply logic to tax code. So it's doubled to 11.2, but that's only for federal. The states still have their own estate tax rules. The gift tax rule, the exclusion amount now increased to $15,000. So you can give up to $15,000 per person per year to as many people as you want to. Tax-free to you, tax-free to them. So you've earned the money, you paid taxes on it, presumably. You're giving it to them. They don't pay taxes on it because it's a gift, up to $15,000. Now, if you pay them more than $15,000, then you've got to file a form, a gift tax form with your tax return, acknowledging how much you paid to them. But as long as it doesn't exceed the somewhere around $2.5 million worth lifetime gift tax, you don't have to pay any taxes for that year. It just counts against your lifetime gifting deduction. Home equity, this is going to hit a lot of people. Home equity loan interest. A lot of folks during the day, not too long ago, took out home equity loans, which were pretty low cost. They were low interest rate loans to pay off their high interest rate credit cards. As of January 1, 2018, not deductible. The interest is not deductible anymore.
I think that's going to be a big surprise to a number of people.
That's going to be a big negative surprise to a lot of people. And there's no such thing as a good tax surprise. and this one's not going to be good. There is one exception. That's why I put an asterisk there. The exception is if you did, and if you can prove that you took out a home equity loan to improve the home, which therefore increasing its value, then you can continue writing off the interest on that home equity loan. If it was used for anything other than that, including maintenance of the home, putting on a new roof does not increase the value of the home. That's maintenance. That's not going to work. But if you if you use the money to put on an extra room of your home, expand the footprint of the home, then it could be. This is going to hit a lot of people in a negative way. This is one that you don't think about. They think about this when they took out the home equity loan and paid off their high interest credit cards. They're not going to think about it again until April 15th of this year.
Yeah.
SALT tax deductions, state and local tax, now capped at $10,000. Now that only affects people in some high tax states, but there are a lot of high tax states. At least a half a dozen or more are going to probably be affected by this. Some are suing to try to get this this law overridden. I don't know how a state's going to tell the feds they can't put a cap on federal tax deductions, but they're going to try. But for $10,000, so what should your clients do? They should look at last year's tax return and see how much of a tax deduction they claimed for state and local taxes. If it was less than $10,000, they probably don't need to be worried this year. If it's more than $10,000, they probably ought to be worried, because there's part of what they wrote off last year will not be deductible this year. This year meaning 2018.
Yeah.
Individual mandate. We're almost wrapped up here. Individual mandate. That's what they call the penalty. And it's under Obamacare, there's a penalty for taxpayers who do not have government-approved level of health plans. So if you don't have a health insurance that meets a certain level, then you have to pay a penalty on that, and you pay it to the IRS. The Congress made the IRS the gatekeeper on this, the money collector, and the sheriff on this, because they're the only one in touch with every taxpayer in America. Hopefully, presumably. And so there's actually a place on the tax form where you've got to check off that you did or did not have government approved level of health insurance, and you've got to attach another form that proves that you paid it, that you did have it if you paid it. Otherwise, you're taxed. You're not taxed. There's a huge penalty for that.
Right.
Well, coming up in 2019, this is the other one. It's 1119. Congress had some uphill battles in trying to get portions of the Obamacare bill rescinded. So they said, okay, let's take an easier route. Let's just drop the penalty amount to 0. So that's what they did, but only for going forward. For 2018, that penalty still applies. If your client, the tax writers claim the purpose of this is to give Americans a greater voice in whether they want insurance or not, or what kind of insurance they want. They shouldn't be told, that's their opinion. They shouldn't be told what level of health insurance they must have. So starting first of this coming year of 2019, they can have anything or nothing. There's no longer going to be, there may still be a reporting requirement because the IRS is slow enough at the draw. They probably will still keep this tax form in place, but there won't be any penalty. So it won't cost you anything. Most of my cost is filling out a form saying, no, I didn't have it. Now, how much of this do your clients know? What do you think? How much did you know?
I can definitely say there were a number of surprises in there. So yes, this is good.
Even for you, the head of Universal Accounting?
Oh, you betcha.
Well, guess what? Your clients are in not as good a shape as you. Although it's passed by Congress nearly a year and signed by the president more than a year ago, I found that almost no small business owners have a clue about this. They don't actually know what's in it. They know there were tax changes in a lot of cases, but they don't know what was changed, and they don't worry about it because they haven't connected it. It affects them personally. Well, remember this: 53 tax deductions were either expanded, reduced, eliminated, or added, and we've only taken a look at all your home business clients and small business clients are going to be subjected to all of these as of retroactive January 1st of this year. But they're probably clueless on what's in it or how the change will impact them. That's huge. That's a huge, that's a problem waiting that's a genie waiting to jump out of the bottle.
Yep.
That is for you. Because why? Because, well, first of all, how do I know that? How do I know what I just said? That your clients are going to be pretty much clueless. Well, I conducted 4 webinars on my followers on this subject. So they ought to be pretty smart about this, right? If they're following me, I guess they're not reading their emails.
It should rub off, right?
I'm not reading the memo because I had over 1,100 people attend these webinars, and 2 of the polling questions I asked polling questions live for real-time responses, and I put them up on the screen. They click A, B, C, whatever applied, and we'd instantaneously then get totals. Here's 2 of the questions I asked them that answers may be interesting to you. First was, how likely is it that the Tax Cuts Act will directly impact your own taxes? 73%, 3/4, said it will or it likely will affect my own taxes. 25% said, I'm not sure. The other ones are saying, well, it probably will, but I don't know enough about it to answer that question, so probably. 2% said it will probably not. Those are 2% didn't pay attention because it's going to affect everybody. Everybody. Who would not be affected, for example, by the doubling of the standard deduction? Who would not be affected by the elimination of personal exemptions?
Those are the 2 I was thinking of as well.
Those are the 2% of the people that they've got their head in the sand. So it ought to be 100% are clueless. But here's the other question. How much do you know about which tax deductions have been changed? See, to know, backing up here, to know that it might affect me, there's one thing. But I need to know what's going to affect me. Is it the 10%, the $10,000 cap on salt taxes? Or is which ones of these tax deductions are going to affect me? Question was how much you know about which tax deductions have been changed. 1%, that was half of the people who had their head in the sand before. 1% said, I'm fully aware of them. Now they may be. Maybe it's a tax preparer, like you guys, some of you guys. The second option was I have at best a working knowledge of them. That was 12%. 87% admitted they were clueless. I'm only vaguely aware or not at all aware of which tax deductions have been changed. So what do we got? Here's the conclusions. 7 out of 10 small business owners said they believe tax deductions will either will or likely will affect them personally. Yet only 13% have even a working knowledge of what those changes are. And 87% have no clue which deductions have been changed. Look at these 3 lines. Does this look like a pattern? No. 3/4 think it's going to affect them, but only 13% even have some idea of how it's going to affect them. And 87% are totally unaware of which deductions they are.
Which is, I think, a very important thing to focus in on, because these are tax preparers that we're talking to here.
On this webinar.
Yes.
Yes. On my webinars, I was talking to small and home-based business owners.
Correct.
Who have a fair amount of tax education.
Who the tax preparers need to be helping.
Exactly. So these are your clients we're talking about.
That's
These aren't
right.
these aren't just people on my list. These are your clients, and yours are probably even worse because they're not on somebody's list where they're constantly learning new tax information. So why should you care? Why do you care? Here's why I think you should care. Because a couple of months from now, or even less, they're going to be burning up your phone or your email or jumping into your office. They're screaming things like, hey, where the heck are my entertainment expense deductions? And you're going to have to explain they're gone. Why'd that happen? When that happened? And you're going to get into a long discussion. You're going to have to become their tax educator. And you're on the defensive because they asked the question, right? It's an attack question. Yeah. Are they going to say, hey, you forgot about all my personal exemptions? $4,050. I have a family of 4. That's a lot of exemptions. Where'd they go? And you got to explain that one. No longer allowed. Why didn't you write off my tax preparation fees? It's in one of those service categories. What happened to casualty loss deductions? Well, your little earthquake there was nice. It hurt a lot of people, but it wasn't on a federally declared disaster area. Why no employee expenses on my Schedule A? Why'd you leave all those things off? All those expenses, I couldn't even find where you would have put it on Schedule A. That's because they're not deductible anymore. Where are my home equity loan interest deductions? Somebody think about that. How come you only claimed $10,000 in my SALT deduction? I claimed $12,000 last year and got a full deduction. Why'd you cap it at $10,000 this year? I mean, how can you preempt your clients from hitting you with all those questions? What can you do to help prepare them to understand so that in advance, so instead of answering their questions, you pre-answer the question? Well, you need to know about this stuff cold. If you're a bookkeeper, accountant, or tax preparer, obviously you need to know this stuff cold. But your clients also need to know something about this stuff. So that, they don't need to know as much detail as you probably, but they need to know, for example, that that there are no personal exemptions anymore, or that your write-offs on Schedule A for out-of-pocket non-reimbursed employee expenses aren't anymore. If they know those things in advance, you'll be hit with a lot fewer of these attack questions. And if anything, you may have to say, remember, that was one of the ones that I said was eliminated. Oh yeah, I remember now. And the discussion's over. So you have a very short conversation. So this is your best interest to do this now, or else you can spend countless hours as their tax teacher. And when will they ask these questions? During prime tax time. Mm-hmm. Exactly. When you're on deadline, trying to get maximum tax returns done, working 26 hours a day, 8 days a week, trying to get taxes done, your clients are calling you, bitching about, complaining about their tax returns because you did something wrong. No, you didn't. They did something they didn't know. So here's my honest recommendation. Here's how I suggest that you learn this stuff cold. Make sure you know this stuff cold, and how you can help prepare your clients with this information. First, we want to make sure you have the new tax knowledge that you need. And then goal number 2 is it's in your best interest to get your clients educated, right? So here's what I suggest to make you make sure that this may be like a check. This may be like a smog test. You're making sure your car is still smog clean. So you may have the information you need, but can you take the risk of wondering, is there something I don't need? Because you don't know what you don't know, right? So my recommendation is to get these 2 companion books. We're going to give you a big discount today off them. And besides, they're 100% tax deductible. You can get both of these books for $49.95, which is roughly half price. That's half of what these 2 books would normally cost. Because they're not books, they're tax guides. And in order to get these, if you want this for yourself, click the link below. And that's how you get this for $49.95. And then be sure and write that off on your taxes as a tax deductible expense, which will then bring your net cost down to like, what, $30 or something like that, $35. Whoops, right here. Now, you want to get your clients up to speed. Here's what we're working on that. These 2 books that we just offered you are immediate download, so you can have this information 10 minutes from the end of this webinar, which is almost over. So you can get it immediately. But we're looking for a way, Roger and I are working together to figure out a way that you can offer these in quantity, in bulk quantities, at a drastically reduced cost. So either your client can pay a lot less money, maybe it's $20, something like that, or you can pay less money to educate your clients. It may be worth sharing the cost even. You may want to pay part of the cost. If, let's say we get down to 20 bucks, you may want to pay 10 of that and let them pay the other 10. The 10 they pay will show they're serious about knowing this. The 10 you pay helps them get it, which is going to relieve your stress on tax deadline. So we're going to figure out a way to do this, and we'll let you know shortly how we're going to do that. But we're working up a schedule of trying to figure out what's the lowest possible price we can make these available at various quantity points.
Well, the whole goal here is to first and foremost help the tax preparer, the people listening to this, become the expert that they need to be and the hero of their client. Because if you can get this into the hands of your clients and help them see in a very quick and easy read what it is they ought to be doing as a business owner to proactively plan their use of the tax code to their benefit, this is exactly what they're looking for. So I think this is a phenomenal opportunity for not only the tax preparer to get on top of the things that you must know. It's a chance for you to preemptively get in front of your client and actually help them now understand what's affecting them so that they're not bothering you during the prime tax season.
Exactly. And if you've got a small number of really important clients, you could even take this Tax Cuts Act, take the table of contents of that, which guess what? There are 53 different chapters. 53 tax laws were changed. You might take that list and paste that into a Word document and highlight the ones that you know affect them personally. So you can focus there and then offer them the book. Either give them the book, buy it for them, buy it with them, or sell it to them. And then, so they will see first that, yeah, I do need this, because here are 6 things that are highlighted here that are going to impact me come hell or high water. And so I better know what these are about. So they're going to be more incentivized to buy the book. And you end up with a better educated client. And as Roger just said, a better educated client means you spend less of your time wasted. I call it wasted because if you're not preparing taxes during tax season, that's wasted time, right?
That's right.
You're spending time backpedaling and describing to your clients why they didn't get some tax deductions that they just don't deserve anymore, but they didn't know they didn't deserve them anymore. That's a waste of your time. So there may be there's probably a cost there that cost benefit to you of having your clients educated.
Definitely.
So we're working on that. We'll have that to you shortly. We'll have the ability for you to buy these in bulk quantities at a very low price shortly.
Perfect. Well, Ron, I love the fact that we were able to go through each of these and give the details and insights that you did. I love the fact that we're talking about this in a way to enable those that listened to literally take advantage of the time now before tax planning or the tax season to do more planning. So with all that in mind, act now, take advantage of this wonderful offer, and more importantly, do the proactive thing you can to be the expert you need to be as a professional tax preparer. So with all that in mind, Ron, thank you for taking the time to do this, for preparing this, and more importantly, thank you for being on top of all this to help us stay apprised as to the changes and what they all mean. So you've done a wonderful job. Any parting thoughts as we wrap up?
Well, I just want to say one thing, and that is that for you tax pros, I'm not smarter than you are. It's just that I'm only focused on this subject. You're focused on a lot of subjects. You can't possibly know as much as I do about this topic because you have to be focused on much more things. So what do you do when you don't have the depth of knowledge you need in a category? Usually it's go to an expert.
That's right.
So well, I'm just trying to be your expert. I don't want your job. I'm not a tax preparer. I don't want to prepare taxes, but I want to get everybody that I know of that's filing taxes to use a tax pro, and use a tax pro that really understands the changes to due to the Tax Act. So thank you, Roger, for inviting me.
This is perfect. Well, thank you for sharing all that information. Act now, take advantage of this opportunity so that you can get the information you need to quickly get on top of this coming tax season. And most importantly, just understand this: if it's about accounting, it's universal. So everybody take care and have a wonderful day.